Good morning and welcome to the Killik & Co market update. There's been lots of volatility in Chinese stocks over the last week following some further action by the Chinese regulator. The Chinese regulator has been becoming increasingly active over the last couple of years, and it's starting to cause a little bit of concern for investors. At the end of 2020, the IPO of Ant Group was cancelled when the regulator stepped in at the last minute. Last month, shares in the ride-hailing app Didi fell 25% after the regulator announced an investigation into the company. And this week, it seems that private tutoring companies in China have been targeted. Private tutoring is very common in China, it's very expensive, it's very popular, it's a multi-billion-dollar industry. And this week, the regulator has suddenly announced that private tutoring companies are no longer allowed to make a profit. So as you can imagine, this has had a devastating effect on the share prices of private tutoring companies on the stock exchange. Here's an example. This is one of the bigger ones. It's called TAL Education. Here's the 2-year share price chart, and this chart shows the percentage change. And as you can see, the shares are more than 80% below where they were about 2 years ago. So why has China done this? Well, some of the speculation says that the high cost of education and private tutoring were actually putting couples off having children, and that had led to a very low birth rate in China. And over the long term, this can lead to an aging population, which is bad news for economic growth. Here's a chart showing the birth rate in China from the 1950s onwards. So as you can see, in the 50s and 60s, the population was growing very rapidly, and there was some concern that in fact it might have been growing too quickly. So in the late 70s, we had the imposition of the one-child policy. And as you can see, that led to a rapid decline in the Chinese birth rate. Then in 2016, a 2-child policy was introduced, and then this year a 3-child policy was introduced. However, the birth rate has still remained incredibly low. As you can see, it has continued to fall. So it seems as though now the government is trying to reduce the costs of raising and particularly educating children in a bid to try and increase that birth rate. That said, the fact that the regulator is willing to make such sweeping changes to entire industries overnight has caused some concern among investors, and it has harmed sentiment and caused share prices in other Chinese companies to fall as well. For example, here's the share price chart for Tencent, which is one of the biggest technology companies in China. This week, the Chinese regulator did meet with a number of industry representatives from around the world in a bid to try and reassure them about the share price. And as you can see, that did lead to a small spike in the share price. However, this does remain a situation that needs to be watched very closely. So if you do have any Chinese exposure in your portfolio, please do give us a call to talk about this in more detail. It's earnings season at the moment, and all of the big tech companies have reported results this week. And we just wanted to mention Alphabet, the owner of Google, because it did achieve a standout quarter. It really is quite amazing that a company so big can continue to achieve such high rates of growth. Here's a chart comparing the revenue achieved by different segments of Alphabet in the second quarter of 2020 in comparison to the second quarter of this year. So as you can see, it's almost doubled revenue in some of these segments. For example, the revenue from YouTube advertising went up from $3.8 billion to over $7 billion. The revenue from Google search was up from just over $21 billion to over $35 billion. So these are really impressive numbers, and they do seem to show that these big companies can continue to thrive even now lockdown is starting to lift. And finally this week, tourism is starting to pick up now that travel restrictions are starting to loosen. This week, England announced it would be accepting fully vaccinated visitors from the EU and the US. While shares in travel companies and airlines have been incredibly volatile because the rules keep changing, it's good to see that shares in airplane manufacturers have experienced a much smoother and steadier path to recovery. Here's the share price chart for Airbus, which published results this week. In fact, it raised its full-year guidance, and it said that once again, airlines are starting to place orders for new planes. So overall, these results were very reassuring. And as you can see, the share price for Airbus is now not too far below its pre-pandemic level. Moving on to have a look at next week, we've got results out from UK banks, HSBC and Standard Chartered, and video gaming company EA Games. That's it from us. Enjoy the weekend, and we'll see you next Friday.